Chapter 14, Financial Performance Measurement. This is a chapter about financial statement analysis. So the first thing we need to talk about is the annual report project. There is a separate tab that discusses the annual report project. It is a large portion of your semester's grade. It is the project that's designed for you to select a live annual report, a live financial statement of an actual company, a publicly held company. You'll be able to find their most current annual report on the internet through a Google search of annual report or financial information or 10K. And you're going to do an analysis based on the information in Chapter 14. So Chapter 14 is actually the capstone chapter of financial accounting, where we use all of the knowledge that we've gained from all the prior chapters to be able to show that we do understand financial statements, how they're prepared, and how they're used. So this chapter will be very helpful to you in preparing your annual report project, and you'll probably refer back to it from time to time when you're doing this large project. So first, what are the objectives? Well, whenever you're analyzing a company's financial performance, you want to know if they're profitable. In other words, have they earned money? You want to know if they manage their assets, their plant, property, and equipment, their trucks, their buildings, etc. Have they managed those well, maximized the use? Are they liquid? Which means, can they pay their bills on time? Because some companies have a profit, but they have so many accounts receivable they're not liquid. Some companies are liquid by having lots of debt, but they are not profitable because they have to borrow money to pay their bills. So let's move on. Financial risk, using their debt effectively. We're going to be looking to see whether these companies use their debt well. And lastly, operating asset management, to make sure that they want to support growth with minimum investment. So where do we get this information from? For the most part, you're going to be using the annual report. Now, the annual report is usually put out in a very nice format with pictures of the CEOs and the board of directors and the product. For example, John Deere has lots of their products shown, as does Boeing. Those are for usually the investors, but it also has to be filed at the SEC, and that is the Securities and Exchange Commission. It's an oversight regulatory group located in Washington, D.C. that ensures that the financial markets are running effectively and that we never have another Great Depression like we did in the 1930s. So the annual report that you will be able to find is going to be online, and it's accessible for any company that is publicly held. There are quarterly reports. They're from Form 10Q, and there are also current reports that might show things like a change in the board of directors or a change in auditors, or maybe if the company is being bought out by another larger business, then that will be shown in their current report. For the most part, you're going to be looking for the 10K to give us all of the annual information. But the quarterly report does provide helpful information for use. There are 5 major parts of a 10K, and incidentally, the 10K usually has more information than the annual report itself that's provided for shareholders or investors. So the 5 major parts, you're going to find the 4 financial statements. Hopefully by now you can name them. Balance sheet, income statement, statement of retained earnings, which on a 10K is going to be called the statement of stockholders' equity. It's going to have much more detail. And the last one we just discussed, the statement of cash flows. Sorry, that's the statement of cash flows. You're going to find these 4 financial statements on all companies. You're going to find footnotes, or that's part of the full disclosure component. So these footnotes are going to tell you everything from their interest rates on their debt to what their depreciation expense was for the current year. You're going to find in their footnotes information about what accounting policies they use. You'll find information related to any lawsuits that they have. You'll also find an auditor's report. Publicly held companies have to have an audit. That's one of the biggest jobs of a CPA. And this audit actually shows that the financial statements have been reviewed by an independent outside CPA, and the assurance is that these financial statements are accurate and correct. So the auditor's report is extremely important. You'll often see it as report of independent accountants. Sometimes it's called the auditor's report, and you'll see the signature of the CPA firm that provided the audit report. Those CPA firms may be familiar to you. Many of our students go work for them. Ernst & Young, KPMG, PricewaterhouseCoopers, also known as PwC, Deloitte, Grant Thornton. These are some of the bigger CPA firms in the world. And they do a lot of the audit reports for these large companies that are publicly held. There is a 5 to 10 year summary found in all 10Ks. Sometimes it's just called a summary. It's usually found actually in this part, in management's discussion and analysis. And it's got highlights of information in the annual report and shows you 5 years so you can analyze trends. And then the MD&A is a very important piece as well. It's management's discussion about what's going on. And when you do the annual report project, you need to skim through the MD&A, but you probably want to make sure that you've got all 5 of these. I often suggest that students don't print a full hard copy of the entire 10K, but they print these 5 sections. So when you look at financial statements, you have to look at the quality of their earnings. This is going back to one of the financial accounting chapters that we covered on the corporate income statements. You have to look at how much other type of income they have. Do they have a lot of discontinued operations? Do they seem to be restructuring? Do they pay a lot of taxes? So these are the kinds of things that you will do when you analyze an income statement. This is a corporate income statement. This is a listing of the corporate income statement. Notice, first of all, that we're going to zero in on income from continuing operations. And that's sometimes shown before, sometimes not. Income taxes, because people like to separate those income taxes. And this information is helpful on this income statement. By the way, this is a corporate income statement, a little more detailed than revenues minus expenses, although the same basic information is there. But this information is helpful because it's going to allow you to see all the different divisions of a company. So we have operating income, we have income taxes, we have non-operating items, which is things such as discontinued operations if they sold off a segment of their business. And then we have net income, which is what you're used to. Here's net income. Finally, we have earnings per share. Some of you may have studied this in a prior chapter. Earnings per share says if an investor, maybe you, anybody can be an investor, if you go online and you buy 1 share of stock in a company, let's say that you buy 1 share of stock in Apple Computers, and there are millions of shares of stock out there, they will take the amount of net income and divide it by all the shareholders to figure out how much the earnings are for your 1 share. It's an important number that we use in financial statement analysis. So let's look at some of the tools and techniques of financial statement analysis. We're going to be studying these 4. This one by far is the bigger one. These 3 provide important information as well, and you will be doing all of this analysis on your annual report project. Horizontal analysis is looking at changes from one year to the next. You look at it by dollar amount and percentage. It's important that the first year is considered the base year. So for example, a student could say that my grades went up from a 3.0 to a 3.3. That means your GPA went up 0.3. But you could also say that it went up 10%, which is much more impressive. And that's what we do when we look at horizontal analysis. So here's an example of Starbucks. This is 09 and this is 08. So the base year is here. So we look, let's take just cash and cash equivalents. We note that cash and cash equivalents increased $330 million, dollars in millions up here, and that represents a 122.3% increase. So we take the 330 here and we divide it into, the denominator is 269.8. That comes up with 122.3%. Don't forget to move the decimal over 2 places before you put it as a percentage. As you roll down through these calculations, you can see some of them that are a little bit, look at this one, for example. Commercial paper, they didn't have any, so there was a 100% increase because it was 0 the year before. Here's an account for, let's see, stockholders' equity. Stockholders' equity went up 22%, which is found by taking 554.8 divided into 2490.9. So this is the way a comparative balance sheet goes. You can also do it on the income statement. Let's take a quick minute to talk about this as far as what it tells us, not how to do some division and multiplication, because this is easily done on a spreadsheet. If I look at this, again, this is 08 and 09. This is the end of the recession for Starbucks. I can see, kind of a shock, that Starbucks income dropped 5.9, almost 6% from 08 to 09 because of the recession. People just weren't buying coffee. But if I come down to the bottom, I can see, wow, that's interesting. Their net income increased. So how can net income increase if their net revenues went down? So as I scroll through what's happening, I see that interest expense went down. Probably they didn't borrow as much money or they repaid some loans. And I see that they really kicked in on ensuring that their expenses dropped. And so think of it this way. If my income goes down 6%, but I start dropping my expenses even more, then I can still come out on top and show net income. Now that is the way you analyze a company's financial statements with horizontal analysis. It's not shown as easily when you just look at the dollar amounts found in this column here, but it is shown very clearly when you look at percentages. Trend analysis is similar, but instead we're going to have a base year and look at 5 years in a row. The base year is always at 100%, and everything else is measured accordingly. Here's an example. Starbucks. The base year, 2005. So let's look at net revenues. Okay? If we thought of 2005's net revenues as being 100%, we can see how each year has changed. And notice that, yes, they kept rising, and then in 2008, they dropped. You can also look at what's been going on with operating income. And it shows the trends that were occurring in this area. And that's an important piece of information for someone analyzing financial statements. Okay, graph of trend analysis helps depict this for those of you that are visual. Notice net revenues going up. They slightly dipped. This is that 6% dip again. But it also shows us what happened to operating income. And an analyst could go back and say something went on here. Their operating income dropped, and that's something you can find out when you do trend analysis. Go back in and look at the financial statements for 2006, 7, and 8 to see what's going on with that trend. Vertical analysis looks at the components of a financial statement and how they relate to a specific total figure. One measure of vertical analysis is common size statements. Vertical, by the way, means up and down. Horizontal analysis, of course, was going from side to side. This balance sheet, total assets, and stockholders' equity and liabilities are 100%. One important thing to remember, you'll take the dollar amount of cost of sales divided into net revenues. That will always be your denominator. Take your gross margin, divide it into net revenues. Take store operating expenses, divide them into net revenues. So everything is based upon net revenues being your denominator. So some tips with using the live annual report. Total liabilities, just a tip. You're not going to find it. Most companies make you go in and add up all of their liabilities. Another way of doing it is to take total stockholders' equity and liabilities and subtract out stockholders' equity. So companies don't tell you total liabilities. I think they do that on purpose. They'll show current liabilities. Don't make that mistake and use current liabilities when you need to use total. Where do you find dividends paid? Usually that's found on the statement of cash flows. Sometimes it's found on the statement of stockholders' equity. Where do you find the market price? Well, it is not on a live annual report, and that confuses a lot of students. The market price is found on the stock market. You can find it on Finance Yahoo, or you can just do a Google search. And what year are you going to use when you do your annual report project? For most of you, you're going to be using December 31st, 2015. Companies like Walmart have a January year end, so you'll be using probably January 31st, 2016. You need to find the most current annual report based on their year end. And it usually takes about 2 months for the annual reports to be published because of the audit. So let's move on to financial ratio analysis, because financial ratio analysis is so important. You've been doing this all along. That helps. It's things like the profit margin and debt to equity. So financial ratio analysis identifies relationships between the financial statements. It's like a batting average. You would compare one baseball player to another based on their batting average. So we will compare a company like Starbucks to another similar company. Lowe's might be compared to Home Depot. Walmart is frequently compared to Target. So financial ratio analysis looks at relationships. Ratios can be expressed in several ways, and a lot of students get confused by this. So this is an important concept for everyone to pay attention to, so that you don't get confused as you see this. Net income, let's say that net income is $100 and sales are $1,000. Okay, so net income is $100, sales are $1,000. You can express this in several ways. You can say that net income is 1/10 of sales. You can say that net income is 10% of sales. You can say the ratio of net income to sales is 10 to 1. Or you can say sales are 10 times as large as net income. Each of these means the same thing. So keep that in mind as you're doing your ratio analysis. Oh, sorry, one more. For every dollar of sales, the company has an average net income of 10 cents. That's one I like to use a lot. I like to be able to say, I think Walmart's is 4 or 5 cents. So for every dollar of sales Walmart makes, they keep 4 to 5 cents on the dollar in net income, based on generally accepted accounting principles. So that's an important delineation. So we're going to start with evaluating liquidity. And that's when you can pay your bills. And it has to do with working capital. So these are the 4 ratios that we will use as we evaluate liquidity. These are just simple divisions. You've already discussed these in your financial accounting class. So I'm going to talk about what they mean as I go through this narration. I'm not going to talk about how you divide. And we will not go over all 8 of these. The 4 on the right-hand side of the screen, I don't typically cover it all, and they won't be on your annual report project. When you go to upper-level classes, though, you will see this. Okay, the current ratio. This tells us, based on the formula that you have there, this tells us that the company has enough current assets, that's liquid assets. These are assets that can be converted into cash quickly to be able to pay off their current debts. The quick ratio is the same thing, except what happens if we don't have any inventory to sell? So it throws out inventory and just looks at very short-term assets, as we call them, the current assets or quick assets. Okay, the receivable turnover says how quickly do we collect our accounts receivable? Obviously, you don't want your customers to wait a long time to pay you. The faster they pay, the better off you are. Lots of times it depends on the company's policy. So a company that gives their customers 30 days to pay is not going to collect as quickly as a company that gives their customers 60 days to pay. But typically it's determined by the industry. Days sales uncollected uses this receivable turnover that you've calculated up here. Here's the receivable turnover. And the days sales uncollected uses this information to figure out how many days have gone uncollected. So let's say that your policy is that you like to collect your accounts receivable every 30 days, and that's how long you give your customers to pay. And the days sales uncollected is 35, then that's not a good sign. That means that you've got too many accounts receivable outstanding. Inventory turnover tells us how fast we turn over our inventory. Think about it this way. A produce market that sells fruits and vegetables turns over their inventory very fast. A jewelry store probably does not. And how much inventory do they have on sale? So typically a jewelry store will have a lot of inventory on sale because their inventory turnover is slower compared to a produce store. So again, we're taking this inventory turnover that was calculated here, and they're used in this formula. Profitability. This talks about whether or not a company has earned a satisfactory income, and it's very linked to liquidity. So here's some of the ratios we'll be discussing. So let's start with profit margin. We've used this all the time. How much money do you make for each dollar of sale? Asset turnover. How many sales can you generate depending on the average amount of assets that you have? You find total assets on the balance sheet. Return on assets. Given the amount of assets that you have, what type of net income can you make? Anytime you see the word return, that means net income in financial statements. That means what do you get back based on the assets that you have invested? Return on equity. Based on the stockholders' equity of the company, how are you doing with your net income? Long-term solvency, our next category, asks whether or not a company is going to be able to survive for a long period of time, or if it's going to have some financial problems. And you'll look at some of these ratios to say, whoops, doesn't look like they're going to be solvent. Solvent means able to pay their bills in the long term. Debt to equity was studied in financial accounting, and it's simply taking total debt, which is liabilities, divided by total equity, which is stockholders' equity. So that's the formula for debt to equity. And it depends on the company's strategy. Just like it depends on an individual's strategy. Some people say, I'm not going to buy a car until I have the cash to pay for it in full. Other people will take out a loan, which is debt. The same for businesses. Interest coverage ratio. It looks at whether or not there is enough income before taxes to be able to pay the interest expense. Cash flows. We can go through this one quickly because that was in Chapter 13. Cash flows are needed to pay debts when they are due. There's one on here new we didn't discuss. That's free cash flow. It's frequently used by analysts to determine how much free cash does this company have after they pay all their bills. So we've talked about the cash flow yield, which is how much cash flow from operations we can get based on our net income. Cash flow to sales. How much cash flow from operations can we get from net sales? Cash flow to assets. Given the amount of assets, how much cash flow from operating activities can we make? Market strength. Market strength talks about the market price of a stock, and this market price is what you're going to find on the internet. Actually, you're going to have to do some research when you look for the market price of a company. So market price is the price at which a company's stock is bought and sold, and it changes by the minute. If you have a second, Google a company you're interested in, like APPL is Apple. And if you just type that into your Google bar, it will pop up and show you what the stock's value is trading at right now, if the market is open. And it will change minute by minute. And it's mostly a perception from the analysts as to whether or not this company is strong. If people are willing to invest in Apple computers and pay a lot for it, then they think that the future earnings are going to be strong. If they don't think it's worth much, then they probably won't buy it at a higher price. And it's helpful if you look at the PE ratio. It's not so helpful if you don't take the PE ratio into account and the dividend yield. Finally, we have the market strength ratios. And these are very important ratios for investors. Very important ratios, because investors want to know about the PE ratio. That tells us how confident the investors are in a company. So the more investors are willing to pay compared to the earnings per share, which are found on the income statement, the higher the PE ratio and the higher the confidence of the investor. Typically, PE ratios are around 17. They've been negative, they've been extremely high. It all depends on the market and the company that you're analyzing. The last one we'll talk about is the dividend yield. And it says, okay, based upon the dividends that this company pays, which can be found, as we've talked about, on the statement of cash flows, and can also be found on the on the statement of stockholders' equity. If you find out the dividend per share, you can also Google it, and compare that to the market price per share, you'll find out the dividend yield. In fact, if you look at financeyahoo.com, you'll find the PE ratio, and it's not always called a price to earnings, it's called PE, and you'll find the dividend yield on the Finance Yahoo. So these types of things are very helpful as you analyze a company and try to determine whether or not you'd like to invest in it. So this concludes Chapter 14. The information in here will all be part of your annual report project that's due during this course, and I hope you find it helpful. These are very common ways to analyze a company, and business majors really do need to be strong in the area of financial statement analysis. I think you're prepared now to do homework and to take the quizzes. And after chapters 13 and 14, there's an exam before we start chapter 1 for the managerial accounting strength. Thanks.